Good evening to you. Well,
All right, so today we are going to look at IFRS 2 share based payments. It is an important standard, and therefore, let us try to demystify any issues, and we shall have also a few questions to go through. Today is going to be quite different because I want us to make use of the articles provided by the SCCA. That's why you are viewing the page, the My SSA Global page. So as we all know, you just go to ssaglobal.com, then come to students. I want us to make use of the technical article on IFRS 2 share-based payment. So when you open, of course, you come to SA qualification. I showed you in our first class. Then you come to SBR. At that point, we look for the technical resources available to the students. Yes, we've seen these. We've seen the examining team guidance, very important, the syllabus. But today we are interested in not even in examiners' reports, but in technical articles. So we move now from the technical articles. There are different groups from A to F, and what we are looking for is under part C, which is IFRS 2 share-based payment. All right, so we are there, and I'm sure now at this point in time we have all covered this standard. Anyone who hasn't gone through this standard? Any student who hasn't gone through this standard? Okay, I presume the silence means we have all gone through it, and therefore we are ready to go through the revision session. As it is our culture that during revision sessions I must give you what you must know, the basics that you must know. Probably if you have a pen and paper, you can note down so that you can follow through during your revision. Of course, when it comes to share-based payments, you know we have what we call cash payment. We can have asset for asset exchange. We can have share-based payment, where instead of giving in cash or undertaking barter trade, you issue out shares. So what you must know is that under this kind of payment, I don't like people who keep disorganizing us. Who's this one? So I was saying that under this kind of payment, you must know that we can either have equity settled share-based payment, or we can have cash settled share-based payment, meaning that I can promise you a number of shares or options, and at the end of the day, you become a shareholder of the company. Or I promise you, I give you a number of options or shares, such that at the end of the period that we have agreed upon, I cash you out. You don't become a shareholder. So those are the two types of share-based payment: the equity settled and the cash settled. And this standard is about those two. So long as you've understood them, then everything becomes very easy for you. As such, you should know the accounting treatments and the measurements therein, both for equity settled share-based payment and for cash settled share-based payment. You can't finish this standard without knowing the meaning of grant date and then vesting period and vesting date. If you think you know you've covered this standard and you can't explain what grant date is or what vesting date is or vesting period, then you shouldn't consider yourself knowing the basics of the standard. Next, you should also know the vesting conditions. There are conditions that we talk about. There are those share-based payments that vest immediately, meaning that they have no conditions. Then we have those share-based payments or transactions that have conditions. As such, you should be knowing the vesting conditions, that is including the service conditions and the performance conditions. Those who are noting down, that is good. And also, we should know what is the impact of the performance conditions on the recognition of either the liability or the equity in our financial statements. So those are the basics that we should know under this standard. One, the two types of share-based payments, their accounting and measurements. Then two or three, meaning of grant date and vesting date. You should know the vesting conditions. And once you know all that, then you are good to go. So as I said, we are going to use this article to demystify any query or any issue about IFRS 2. We can see that we are told this standard applies when a company receives goods and services in exchange for its own equity instruments, that being the first mode, or a cash amount based on the price of its own equity instruments. Those are the two types. You receive goods and services, and in return, you either issue out equity instruments so that the receiver becomes a shareholder in your company, or you cash them out depending on the price of the shares of your company. And they are telling us that you can, of course, receive goods like inventory, PPE, intangible assets, or other non-financial assets. Please note, there are two notable exceptions. Shares issued in a business combination which are dealt with under IFRS 2, IFRS 3 business combinations. Yes, we've seen where we can have share for share exchange during business combinations. That is not accounted for as per IFRS 2, where one company acquires equity ownership in another company and it also gives out its own equity to the shareholders of the other company. That is not under IFRS 2, but under IFRS 3 business combinations. Then they're also telling us that, and contracts for purchase of goods that are within the scope of International Accounting Standard IS 32 financial instruments, or IFRS 9. And even when it comes to financial assets that are covered under IFRS 9, IFRS 2 does not come in. In addition, a purchase of treasury shares would not fall within the scope of IFRS 2, nor would a rights issue where some of the employees are shareholders. So those are exceptions that in case you find them in an exam, you shouldn't think about IFRS 2. Okay. So what is the recognition of share-based payments? The standard says IFRS 2 requires an expense to be recognized for the goods or services received by a company. If you receive goods or services, then you should recognize an expense. And then they are telling us that the corresponding entry in the accounting records will either be a liability or an increase in the equity of the company, depending on whether the transaction is to be settled in cash or in equity. So, once you receive an asset, this is the issue of double entry. You debit intangible asset. What do you credit? You either credit a liability if you're going to pay cash. Okay, that is if you're going to convert the shares you are issuing to someone or the options you're giving to someone into cash based on the fair value of the equity instruments, or you're going to credit equity because you are issuing equity to this person who has provided the goods or services. So this is very important, that whenever you receive goods, you must recognize an expense. And in IFRS 2, the expense can be either a liability or equity. A liability under cash settled or cash-based settlement, or an equity under equity-based. Goods or services acquired in a share-based payment transaction should be recognized when they are received. This is important, as it is what we call accrual concept. When you receive goods or services, then recognize them when you have control over them and you can enjoy the economic benefits. So they are saying, in the case of goods, this is obviously the date when this occurs. However, it is often more difficult to determine when the services are received. If shares are issued, that vest immediately. I talked about this. If you issue shares and they vest immediately, meaning that there are no conditions, then it can be assumed that these are in consideration of past services. As a result, the expense would be recognized immediately. So they are telling you, however, if you have options that are vesting in future, okay, then it is assumed that the equity instrument relates to future services and recognition is therefore spread over that period. Any question regarding this part, or I proceed?
Hello?
Yes, please.
Yes, mine is on the. I know those two methods, the cursed and the equity method. Since you have a credit entry going to equity with the equity settled, it makes sense it going as a share based payment because we're actually getting more equity coming as a result of that acquisition of goods. But now, when you come back to the side of the cash settled, the credit entry goes to the liability. I don't see any interlink as it is concerned, which is just a basis of a mode of a payment. It's just going as that we shall just use the fair value of the share to determine your payment, do the cash settled. Then you don't end up having the actual equity component.
Yes. You see, why it comes under share-based payment, it is attached to the performance of the equity instrument. You get? We are telling you that we are giving you 100 options. After this period, we shall convert them into cash. So it does not give you ownership, it just gives you interest in the business. Does it make sense now?
Yes, yes. Okay, that's like a confusion's coming in, because I thought it would actually give me the equity in the business. I know that somebody would acquire equity
Not really.
in that caliber.
It does
So
not
it is
give
just the interest.
it is okay. I don't mean interest in terms of interest like interest rate. Interest I means stake. You get it?
Mm,
Like you have an interest in the business because they have given you some shares that are going to be converted into cash at the vesting date. So that gives you interest in the what? In the company, but not ownership. And we are going to have common examples, especially the share appreciation rights. Eh? Okay. Yeah, let us proceed.
yes, Ivan.
Yes, please.
Yes, I was saying that if have the interest, then wouldn't have gotten a portion of equity of the business. Wouldn't there be an increase in equity?
Please.
That portion of the interest I get from the cash settled, because in terms of entries, I see that they only go to liability and then the expense.
You see, it does not give you ownership. Okay. As I've told you, we give you 100 share SARs, share appreciation rights. Okay. That after completing this number of years, we are going to convert those shares into money. You see, we have not told you that we are going to give you 100,000. No, we've told you we are giving you 100 shares or options, and the value of those options is based on the fair value of the equity instruments. So that makes it a share-based payment. It does not give you ownership in the company, but its value depends on the performance of the shares. Okay, so as we said, we have two types: equity and cash. Let us look at what the technical article tells us about equity settled transactions. It says that equity settled transactions with employees and directors would normally be expensed and would be based on their fair value at the grant date. This is very important. It is talking about the measurement of equity settled transactions. And if you can remember very well that diagram we had in the notes, I'll go through it when it comes to the word document. Fair value should be based on the market price wherever this is possible. Many shares and share options will not be traded on an active market. If this is the case, then valuation techniques such as option pricing model would be used. However, IFRS 2 does not set out which pricing model would be used, but describes the factors that should be taken into account. Yes, we are going to cover these pricing models in AFM. Those who are going to take up AFM, we have something like BSOP, Black Source, option pricing model. We shall cover them to detail. So we are saying, the summary says, if you cannot find the fair value of the options on an active market, like the stock exchange, then you can use option pricing models. And I've given you one example of option pricing models, the Black-Scholes option pricing model that you're going to cover in your AFM paper. Since this standard does not specify which model to use, but it says intrinsic value should only be used where the fair value cannot be reliably estimated. You can only use intrinsic value, and intrinsic value is just the difference between the fair value of the options and the price that is to be paid for the shares. The fair value, intrinsic value, is that innate value of the options, which is more of the difference between the fair value of the shares on the active market and how much is going to be paid out for those shares. Okay, the objective of IFRS 2 is to determine and recognize the compensation costs over the period in which the services are rendered. For example, if a company grants share options to employees that vest in the future only if they are still employed, then the accounting process is as follows. Now, meaning that we talked about the vesting conditions. If it is not vesting immediately, it is therefore going to vest in the future. And there are conditions that for you qualify to become a shareholder of our company if you spend the 5 years with us. At that point, the standard says the fair value of the options will be calculated at the date the options are granted. If you can remember, in our drawing we had in the lectures, we said for the measurement of the value of the transaction entered into under equity settled payments, if the transaction is with an employee, then you should measure the fair value of the equity instruments at the grant date. What does it mean? That if we are going to give you 100 shares in the company and you are an employee of that company, then the value of that transaction, you have gone to render us services and we shall pay you some money. The fair value of that transaction is calculated at the fair value of the options at the grant date. And the grant date is when you have entered into a contract that you will have options, you will have shares in our company if you spend this much time with us. Is that clear? Okay.
Yes, it is clear.
Perfect. And after doing that, we are saying this fair value will be charged to profit or loss equally over the vesting period, with adjustments made at each accounting date to reflect the best estimate of the number of options that will eventually vest. Here they're trying to tell you that you can issue out equity shares to 100 employees, but after the first year, 2 can leave. And when they leave, it means that that obligation has been forfeited because they have not completed the period given to them. So, at each reporting date, you have to review the conditions to see if what you issued out will fully be given out at the end of the vesting period. Shareholders' equity will be increased by an amount equal to the charge in profit or loss. This is just double entry. Okay? That you're going to expense, we said the fair value will be charged to profit or loss equally over the vesting period. This is the debit. You debit an expense and then you come and credit equity by the same amount. Debit, profit or loss, expense, credit, equity. The charge in profit or loss reflects the number of options vested. If employees decide not to exercise their options because the share price is lower than the exercise price, then no adjustment is made to profit or loss. Yes, at one point, you can have, you see, they told you that we are giving you these options, okay, but you pay this much. But by the time that after 5 years, the amount you're going to pay is way above the share price on the market. As a sane investor, can you pay more than what the market participants are offering on the market? Who can answer that? Can you do that?
I wouldn't pay more.
You
They're
wouldn't
not.
pay.
Okay.
So we say you forfeit that option. Meaning that if the share price on the market is lower than what you agreed to pay, exercise price in the contract, then you don't buy those options. You let them to lapse. That's the word that we use. You let them to lapse. And so, as an accountant for that company, once employees have forfeited their options to buy shares in the company, then you do not recognize you don't make any adjustment in the profit or loss for that year. All right, we are talking about now early settlement of an award without replacement. A company should charge the balance that would have been charged over the remaining period. You see, with early settlement, maybe if you allowed to vest the options before the period that you had agreed upon, then you should charge that remaining amount over the company financials. Let us have an example. On 1st June 2006, a company purchased inventory, debit inventory, and paid for it by issuing shares to the supplier with a fair value of 6.3. Now this is very tricky. This transaction is not with the employee. We said for the employee, we must use the fair value of the options at the grant date. Okay? When it comes to other parties who are not employees of the company, then the standard says, can you obtain the fair value of the goods? If yes, then you debit the asset you've received with the fair value of the goods received, and you credit equity with the same amount. But if you cannot get the fair value of the assets or of the goods that you've received, then use the fair value of the options at the grant date. Is that clear with everyone?
Yes, it is clear.
Yes, it is.
So this is the example they are giving. This transaction is with a supplier, not an employee. Meaning that we should consider, do we have the fair value of the inventory? In this question, yes. No, they are saying that the fair value of inventory on 1st June, get it very well. On 1st June, we said we use the fair value of goods on the date when goods are received. So on 1st June, a company purchased inventory and paid for it by issuing shares to the supplier with a fair value of 6.3. The fair value of the inventory on 1st June is 6. How will this transaction be dealt with in the financial statements? This supplier was lucky to receive shares worth 6.3 million. But the fair value of the goods, let me first hide this. The fair value of the goods, okay, is 6 million. So they are asking you, how should they treat this transaction? Who can try?
I think since we are covering receiving inventory, we debit inventory and we credit at 6 million. Then we credit the whatever equity cash.
Equity.
Yes, that's what I think.
With how much?
6 million.
Perfect. Because we said when it is not with when it is with someone not an employee, we take the fair value of the goods. We only take the fair value of the options if the fair value of the goods is not available. So you got it. We should take 6 million and not 6.3. Let us see what the article says. IFRS 2 states that the fair value of goods and services received should be used to value the share options unless the fair value of the goods cannot be measured reliably. Thus, equity would be increased by 6 million and inventory by 6 million. So this is the double entry you talked about. Is that clear with everyone?
Yes.
All right. So those are the basics that we should know. We talked about performance. You see, we talked about employees spending time. Where is it? Somewhere. Employees spending time. Where is it? It's somewhere here. Okay. We all know that when these equity instruments are provided to employees, they are told that you should work with us for this number of years. That is what we call service condition. Okay? A service condition requires an employee to work with the company for a given period of time. Meaning that if you do not complete the years, you have not qualified to get or to buy those options at the exercise price. Now we have what we call performance conditions. Understand it very well. There are two types of vesting conditions. Service condition, you spend time with the company. 2, performance conditions. And now, when it comes to performance conditions, here we attach what we call performance targets. Let us read what the article says before I dive into the explanations. Schemes often contain conditions which must be met before there is entitlement to the shares. These are called vesting conditions. Conditions specifically related to the market price of the company's shares are called market conditions, and these are ignored for the purposes of estimating the number of equity shares that will vest. Please take note, when it comes to performance conditions, there are two types. 1, market conditions. 2, non-market conditions. For market conditions, okay, those that depend on the performance of the share options, what we call the market conditions. In fact, they are tied to the performance of the equity instrument of the company. Those ones, we do not look at them when estimating how many shares are going to vest. Do you know why? These are already integrated into the fair value of the equity instrument. That's why we say, for market conditions, ignore them. What does it mean? Even in your exam, you must, if it comes, you must talk about this. That IFRS 2 requires that all market conditions should be ignored when estimating the number of equity shares that will vest. The thinking behind this is that these conditions have already been taken into account when measuring the fair value of the share options. I've talked about that. Any question regarding market conditions, or I proceed? Or want me to give you an example? Yes, please. Any question? Okay, let me give an example of a market condition. We've said that market conditions are attached to the fair value of the equity instrument, and so we should ignore them. And the reason, let me give an example is, we give you, you are our employee, then we say that we are going to allow you to buy our shares at $2 if the share price of our equity instruments is $5. Now at that point, they have put a condition for you that for you to exercise your rights of the options, the share price should be at this market price. So we are saying when you're calculating how much to vest, you do not consider that condition. Why? Because we have already taken it into account when estimating the fair value of the share options. The article gives us an example. A company grants 2,000 share options to each of its 3 directors on 1st January 2x6. As someone who knows that we talked about, if it is employees, fair value of the share options at grant date. Grant date, 1st January. How many options given? 2,000. How many employees? 3 employees. Now we must look for the fair value of this share at 1st January, because that's what the standard tells us. The options will vest on 31st December 2x8. Those are roughly 6, 7, 8, 3 years. Okay, that's the vesting period, 3 years. If the directors are still employed, this is a service condition. If the directors are still employed, then they add on a performance condition. And if the company share price reaches $14 per share, so there is a performance condition. The share price should rise, and this is a market-based performance condition, which we must ignore. The fair value of each option on 1st January 2x8, the fair value of the option at the grant date is $10. Very important information. The share price at 31st December 2x8, the share price at 31st December 2x8 is $8. And it is not anticipated that it will rise over the next 2 years. Remember, for you, they told you if it is directors, always use fair value at grant date. So this information is just to confuse you. At 31st December 2x6, it is anticipated that only 2 directors will be employed on 31st December 2x8. Now we are trying to assess. We said at each reporting date, we must assess if the service condition are going to be met. Okay, how will the share options be treated in the financial statements for the year ended 31st December 2x6, the first year? They have told you, man, at 31st December, 2 guys are likely to be employed. So one is going to leave. In the question, they can say it is anticipated that 1 director will leave, meaning that 2 are going to be remaining. They'll just change the phrasing. It will be the same thing. All right. Answer. The market-based condition, the increase in share price can be ignored for the purpose of the calculation. So for you in the exam, you're going to say, as per Ifrs 2, or in accordance with Ifrs 2. Entity, or you can even name the company. Company A or an entity should ignore market-based conditions such as increase in the share price when calculating the amount to be recognized. However, the employment condition must be taken into account. This is a service condition, for it has to be catered for. So, we all know this formula. And by the way, in your exam, don't waste your time writing formulas. Dear students, there is no single mark for a formula. That number of options times employees remaining times share price, fair value of the option, times the prorated time. No one gives mark for that. This is a standard, this is a professional paper where they mark this final value. And even if you get it wrong, but you go ahead and write here something correct with own figure rule, you've only failed this point, you get this mark. So this is application and not number crunching. Okay, so you're going to say that, of course we know that the formula is number of options granted times directors remaining through the vesting period times the fair value of the options at grant date. Then times, this is the first year out of the grant period of 3 years. Meaning that we are going to expense this figure, debit, expense, which goes to profit or loss, this amount, and then credit equity by this amount. Is this clear with everyone? Yes, please.
I have a question for clarification on something. So, in the question, they said it is anticipated that only 2 directors will still be employed on 31st December 20x8. Doesn't that apply for the 20x8 since they have asked for just the 20x6?
Does it apply?
For the case of, okay, doesn't the condition, okay,
This one here.
that part where they're talking about 2 people remaining, doesn't it only apply for that year? Because, okay, we are now looking at, the question is looking at 31st December 20x6.
If you watch the video, the lecture video, I explained that thing very well. I said, when you are standing at 31st December, okay, that is the point where you want to know how much should I charge in my profit or loss. Do you know why? Because you must call it an expense for these guys who are going to remain in service, who are likely to fulfill the service condition. Otherwise, you don't say that because the other one guy has served the other 1 year, he qualifies. No. He does. It means that he's going to leave, so he's ready to forfeit that expense or that option. Are you getting it? So we stand at the reporting date and see. Yes, we have 3 directors, but one is likely to go. Why do we have to spend on him? Since he's going to forfeit his chance. So let us only expense, or let us only provide an expense for those who are going to exercise their option. Does it make sense?
Yeah. Thank you.
You're welcome. Someone I think had yes, Raymond.
Now my question is, suppose like I failed to get that 13,333, but then I continue down, I put down the statement, then I put down the double entries. Will they give me the extra mark? Like, remember I've already not put down the 13,333, but then I've come down and I've put the double entries. Will they give me an extra mark or to compensate for this one that failed?
Yes, let me let me give you a practical one there. It's what I was explaining. Assuming that you took what okay, I'm forgetting someone's name. Assuming that you took what Patience said, okay, and you considered this as 3 directors. You get it? You forgot. So that would give you 2000 times 2. Times 3. 2000 times 3 times 10 divided by 3. Here you would get how much? 20,000. You get it? But if you get here 20,000 and then you come and say debit expense 20,000, credit equity 20,000, then you say that company X should charge 20,000 in profit or loss as an expense and increase its equity by 20,000. You only fail the mark for this and then you get the mark for application. Have I answered you?
So I think like now for that, yes, I've explained it using a statement. So for me, I was saying like if like I continue down and also put the double entries, I put like debit, whatever, then credit, the equity. Like, can they give me that other mark to compensate for this color that I've lost?
No. A double entry, you see, even a student who just wrote debit expense 20, credit equity 20 would get the same mark as you who wrote this. So they don't
Okay.
give extra mark. This one you've lost it. This is also a mark on its own. So you either use a double entry or use a statement. Is it clear now?
Yes, thank you.
All right. So if this is clear, guys, understand very well, so that I'm going to take you now to Word document. I give you a question, you try out, we discuss it. So have we understood performance condition? Performance conditions, there are 2, market and non-market. We've said that for market conditions, we ignore them. But what are the non-market conditions? The non-market conditions is the opposite. They are not related because I'm seeing the article is not talking about them. It is going directly to cash settlement. Okay, the non-market conditions are not in any way related to the market price of the what? Of the equity instruments. Example of market condition can be, you are going to work for us, but you must achieve 20% profit margin. Or you must increase the profits to 100 million. Or you must work hard so that our earnings per share moves from 3 to 5. So those are non-market conditions. And for them, trust me, if they are not met, then you do not have the right to expense. But if they are met, that's when that expense should be recognized. Is that clear? Or I need to differentiate between market conditions and non-market conditions? Do I have to? Guys, is that okay?
For me, it is okay.
Alright, so let me hope you don't forget examples of market condition. The share price should rise to this much. That is a market condition. Profits must rise to this. That is a non-market. Put it into consideration. The other one, don't consider it. Okay, we go to the second type of share-based payments, cash settled. We said you offer your services, then we tell you we shall give you money but using the fair value of the equity instruments at that date, at the exercise or at the vesting date. Cash settled based payment transactions occur where goods or services are paid for at amounts that are based on the price of the company's equity instruments. You give us your asset, your car, we give you money based on the price of our equity instrument. The expense for cash settled transaction is the cash paid by the company. An example, this is very important, share appreciation rights. And you're going to find that we always talk about this SARS, S-A-R-S. Entitle employees to cash payments equal to the increase in the share price of a given number of the company's shares over a given period of time. This creates a liability, and the recognized cost is based on the fair value of the equity instrument at the reporting date. Now, if you remember, we said that the cost or the transaction value under equity settled is based on the fair value at grant date. And so, we do not look at any other fair value going forward. When it comes to cash settled, we always look at the fair value of the instrument at each reporting date. That's why you're saying the fair value of the liability is remeasured at each reporting date until settlement. For equity settled, we do not look at the fair value at each reporting date. Whereas for cash settled, we must look at the fair value at each reporting date. Is that clear with everyone?
Yeah, to me it is. Yeah.
I think you pardon me on that.
Yes, I said under equity settled, okay? Under equity settled, these ones, the expense or the transaction value, if it is between a company and its employees, the value is the fair value of the options at grant date. If it is between third parties and the company, the transaction value is the fair value of the goods. And if you can't get the fair value of the goods received on that date of receiving them, then you use the fair value of the equity instruments at grant date. We don't revise the fair value of the equity instruments going forward. When it comes to cash settled, yes, we use the fair value of the options, but now for it, at each reporting date, you must obtain the fair value of the options. Does it make sense now?
Yes, it does.
At each reporting date, you must remeasure the fair value of the transaction. We have an example. J is a public limited company with a year end of 31st July 2026. By the way, you tell me, am I too fast? I'll give you some few minutes to take some water. Yes?
You're not.
Okay, we can proceed. J is a public limited company with a year end of 31st July to X8. I mean to X6. On 1st July to X5, it granted 300 share option rights to each of its 500 employees. These are SARS, and SARS are cash settled. Whenever you see SARS, just know they are cash. This one here, just know you're dealing with cash settled what? Options. Okay. It granted 300. How many employees? 500. The vesting date is 31st July 2x7. When were they given? 1st July 2x5. So those are 2 years. Vesting period 2 years. The fair value of each share appreciation right on 31st July 2x6 is 15. We said at each reporting date, make sure that you obtain the fair value of the options. Okay, so that is 1 year. And that is the date when they want us to account. At the 31st July 2x6, management believes that 80% of the employees will still be employed on 31st July 2x7, meaning that the 20 have left, and so we should only account for the 80. This is a service condition. And by the way, the conditions we saw under equity based are the same conditions under cash based. So this is a service condition, and when we are calculating our expense for the year, we only take into consideration the employees who are going to remain with the company, those who are going to exercise their options. Okay, how will the transaction be recorded in the year ended 31st July to X6? Because that is 1 year, and we are saying these are the things that you should know. As per IFRS 2, when accounting for cash settled payments, the liability should be measured using the fair value of the rights at each reporting date. That is your state. As such, the expense should be recognized over the vesting period of 2 years. How do you get the 2 years? 1st July 2x5. When are they vesting? 2x7. 2 years. Okay. And the formula is the same. 300 rights, 500 employees. But how many? Now this one is the number of employees who are remaining. The 500 times the 80%. Because the 20 will not fulfill the service condition. Times the fair value of the option at what date? At the reporting date. In your exam, they can give you 2 fair values at different reporting dates. So for you, follow the reporting date that they want you to account for. Then times 1 out of 2, since it is the first year, to give you 900. Meaning that you're going to debit an expense, 900, you credit a liability, because this is a cash settled. It creates a liability, not an equity. Is that clear with everyone? And we proceed. Yes, please.
So, like, for this cash settled share-based payment, we're supposed to recognize the fair value of the rights at the each reporting date. So, for example, if 2016 we have 14, and then 2017 we have like 18, where do we take the difference? Where do we classify the difference? Or we do not need to classify it anywhere?
And now you see this is like cumulative. Which number did you give in
2016 and 18?
Yes, so that 3 is going to be the expense for the year.
Oh,
you get
okay.
it?
Yes, I get it.
So the difference is this is cumulative. We are going to have it in the example we are going to do. It is cumulative.
So we take that whatever the difference to the PL.
Yes.
Or as the expense for the year, right?
As the expense for the year. Because it moved from 15 to 18.
Okay, thank you.
Then deferred tax implications. This is IFRS. This is IAS 12. I will not so much go into it, but you can read about it. I know once you guys are done with IAS 12, it will make more sense. We'll talk about deferred tax assets and deferred tax liabilities. Then the disclosures are given, and we come to the end of the standard. I'm sure we've covered the details of the standard, and you also covered them in your class. Is there any question, or I bring up the example?
So, for example,
Evan,
Yes, please.
you can hear me?
I can hear you.
Okay, yeah, yes. So I know when we're doing the proration of the people
Yes, please.
who
Can't, can't hear
actually
you.
left, okay, I know that's how the standard. What about now?
Can you please?
What about
We are not getting you.
Hey, what about now?
Yes.
Can you hear me now?
Yes, please.
Yeah, what I was saying, I know that, yes, I know when we're trying to get the accessible rights, we look at the people who have actually left at a particular reporting year, and then those we hope that would leave. Yeah, so those that we hope that would leave, why do we consider them as if they're also going to leave? Because I know it's just a hope that they will leave. Why do we actually take them as if they're actually going to leave?
That's why you see at each year end, yeah, you take into consideration those service conditions. So that if in the first year you assumed 70% are going to remain, and the next year you have 80%, then you can revise. You get it?
Hmm.
Yes. So we assume that, you see, this is probability. You can't be certain how many are going to leave. That's why we are saying you put into consideration when you're standing at the exact reporting date. Then you assume, okay, these ones are likely to leave. Let me put that into consideration. I don't know if I've answered your query very well, but that is my view about that.
Yes.
Yes, please.
Okay, it's okay.
so then, like I told you about the 16 and 18. So, if I'm like stating it, if it's like doing the paper, can I state it out or it's irrelevant?
Stating what?
The difference, where the difference goes.
Hey, we are going to have an example. You have to show how much is going to P and L.
Oh, okay. Thanks a lot.
Let us have an example. Okay, let us have an example. So I'll need to move you guys. I'll need to move you from my browser to the Word document. But let me hope you have benefited in that. Okay, this is our revision. Okay, there we are. And then for those who are going to benefit from the recording, let me make the adjustment as well. All right, so let me get a question here that we can try out. I'm getting the question. Please be patient. I share it, we'll go through it. And I think, was it Raymond who has been asking the very good questions regarding the calculations? I'm sure we are going to do 2 questions, and at the end of the 2, all your queries will be sorted. Okay, let me get a question here. Here we are. Okay. Yes, can you please confirm if you can clearly see the example? I thought it could be on one page so that scrolling is avoided and you guys can let me remove this. It is not important. I move this up. Okay. What if I do this to 12? Okay. So that is the question, and they are saying how much of an expense for the share-based payment scheme should be recognized in the consolidated profit or loss of RUMCO for the year ended this. Your answer should include a brief discussion of how the vesting conditions impact. I want everything to be on one. I don't know if. Okay. How about this? These are just 5 marks. We don't need them. Oops. It's making it worse. I want to balance it. Alright, so is that visible enough for you guys to read? Is it visible enough, please? Confirm.
Yes.
Okay, let me give you 10 minutes. 10 minutes, though you need only, what is 5 by 1.8?
9.
9, yeah? Yeah, you need only 9 minutes. I'm giving you 10. Go through it and put your answers in the chat box. trick is not perfecting the answer, but following the technique. There are very many free marks in that scenario. It is a rich scenario, so type something so that now we can continue. Just pick the basics that we learned in the standard, type those ones, you get the marks. And that is how rich SBR scenarios are going to be. Trust me, that scenario has other questions, but I'm testing for the ability to only extract what is relevant for Roman number 1.
Can you text whatever via WhatsApp?
You can put in WhatsApp group, it's okay. Right. I think we have responses from each of us here. So let us try to go through the question and see how each of you responded. I'll also give my views as far as the question is what is concerned. Okay, so as I told you, can you please confirm if my audio is clear and my screen is visible?
Yes, they are.
Yes, it is.
All right. You are going to find scenarios. You see this scenario has another question, Roman number 2. But Roman number 1 is interested in something, meaning that you should be able to identify which areas should answer Roman number 1, and then the other information you leave it for other questions. You don't have to fight to use all the information in the scenario. We can go through. L acquired 60% of 10 million equity shares of H on 1st July 2x7. So this one is a group accounts question 1. So this is important for you to know that it acquired control over Haman because it has over 60%. But also it is important to know the date. On 1st July 2x what? 2x7. Two room core shares are to be issued. Now this is a share for share. Are to be issued for every 5 shares acquired in H. Remember when we were reading our technical article, we said IFRS 2 does not apply for share exchange under business combination. So we can't say that this statement, this one here, is about IFRS 2 Roman number 1. No, because IFRS 2 doesn't cover that. These shares will be issued on 1st July to X8. They will be issued on 1st July to X8. So that is after 1 year, meaning that it is a deferred consideration. Those who have already looked at group accounts, that is a deferred consideration through share for share. The fair value of Lumuco's share was 30 at 1st July to X7. This is all for group accounts. They are telling you that you have the fair value of the acquirer's equity instruments. Haman Co., who is the acquiree, had previously granted a share-based payment to its employees with a 3-year vesting period. Okay? So, the subsidiary had a running share-based payment to employees. And on the date of purchase, the employees had completed their service period but had not yet exercised their options. So meaning that while L was purchasing H, there was already an obligation to pay H employees or to transform into equity, and therefore they become shareholders. Okay. The fair value of the options granted at 1st July. So you see, the fair value that are to be settled are worth 15 million. They are worth 15 million. As part of the acquisition, Lumuco is obliged to replace the share-based payment scheme of HCO with a scheme of its own, which has the following details. Very important, that these guys are now supposed to issue another scheme, and this scheme should have the following details. Okay, ELCO issued, now very okay. The parent now issued 100 options. Very important. To each of how many cores, number of employees. Very important. You see, on the date of acquisition of Harmonico, these guys gave 100 options to 10,000 employees. Now, if you remember the formula, that shows that now you can easily start thinking about a number. The shares are conditional on the employees complete a further 2 years of service. So, this is a service condition. And that's why the question talks about this. If you remember, that is a service condition. Additionally, the scheme required that the market price of Rumco's shares had to increase by 10% from its value of $30 per share at the acquisition date over the vesting period. Who can tell us which condition is this? Which condition is that?
Market condition.
Market conditions.
Perfect. So, in your answer, you should talk about all of those. Even in your state, because the scenario is talking about a service condition, it also talks about a performance condition, which is a market condition. It was anticipated at 1st July 2007 that 10% of staff would leave over the vesting period, but this was revised to 4% by 30th June 2008. Remember, this is an equity-based payment. So that is also very important. That is also very important. Okay. The fair value of each option at the grant date was, so they're telling us that, remember, we should value the options using the fair value at grant date. And you also have to talk about this in your answer under state, that as per IFRS 2, equity share-based payments should be valued at fair value at the grant date. Then in your application, you bring in the 20%. So meaning that our calculation is done. We have this 20, okay? We have the 100, perfect. We have the 10,000, perfect. Then we also have the 10%, perfect. All the others are just to confuse you, and then some just to apply the standard. Okay, the share price. Yes, Patience.
I have a quick one. I want a clarification on that 10%, but they're also talking about it being revised at the period, at the end of the period.
But we talked about considering for equity based, okay?
Yeah.
We don't consider at reporting date, we consider at grant date. You remember that?
Okay, yeah.
That
I
was
get.
that was the
Okay, thank you.
Okay, so we proceed. The share price of ELCO at 30th June was this. Remember, since this is an equity settled, the fair value at reporting date is useless. Why? We consider everything at grant date. Okay. So how much of an expense for the share-based payment scheme should be recognized in consolidated statement of profit or loss? The trick is, guys, with professional papers, there is less of number crunching and more of writing. I want you to understand that. And once you appreciate it, then you earn the marks. Alright, so after trying to show this, I think now you can see where the answers are. Let us go through your work. I also give my views before we call it a night. We have only 9 minutes. Okay, Raymond. As per IFRS 2, the share option should be recognized over the vesting period and expensed in the statement of profit or loss. And since they are employees, the shares are to be valued basing on the grant date. Something is missing here. Just stating that is not good enough. They should be measured using the fair value of the equity instrument at grant date. Raymond, do you get that?
Yes, I get it.
So this is not enough to earn you a mark. Yes, they should be valued basing on grant date, using or basing on the fair value of the equity instrument at grant date. That's when you get the mark. In accordance to IFRS 2, the share should be recognized if the service performance has been accomplished. Okay? Probably partially you can get a mark. I would say here good. Furthermore, the market condition of the rise of the shares of this from its current price should not be considered, for it has already been incorporated into the share price. Is it the share price or into the fair value or the market value of the equity instrument? This would also not get you a mark. Therefore, the shares offered to the employees should be valued at 20, for that is the price at grant date. This does not give you a mark, because you have information in the question. You have 100 options, 10,000 employees, 10%, 20. Now, what does this mean? No mark. Therefore, the equity will increase and the payment expense in the statement of profit or loss. Okay, this one can get you a mark, but would make more sense if you had attached even a wrong value to it, so that own figure rule can apply. This is just, let me use small g to show it is somehow okay, but not enough. Okay, I can use this, even this. So, Raymond, you didn't do well because you left out free information. This first paragraph was just to give you a hint on another part of the question. The information that you needed. They even told you Lumuco is obliged to replace the share-based payment scheme of HCO with a scheme of its own which has the following details. Meaning that for Roman number 1, this was the paragraph for you to use. As clear as that. Okay. Raymond, that's how you performed. Patience. In accordance with IFRS 2 share-based payments. Patience, don't waste time. Even if you don't put this, no one is going to penalize you. Time is very important in these exams. You just say in accordance with IFRS 2. You'll find that there are those standards with very long names. Revenue from contracts with customers. Don't need to write all that. Equity settled share-based payments are payments made by an entity in form of shares or share options for the services received. Yes, it is good, but not good for you to define. So this was just for time wastage. Though it is good, but not really necessary in the question. The definition. Oh, I'm supposed to use a different. Yes, it just took your time, but okay. The standard also states that an entity is required to consider the non-market conditions and ignore the market conditions as their basis to determine the payments. Ah. So, are you saying that they should ignore what the service conditions? Patience.
I say they should ignore the market condition. The service conditions are indeed the non-market conditions.
Yes, but something is lacking, but it's okay. You can give it.
So I should use service conditions to be
No, 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 no,
specific.
no. No, this is okay. You get it? But it's as if it means there are no other conditions to put into consideration. So try to phrase it as if you're trying to compare non-market versus market.
Okay.
Because there are also other conditions like the service condition, which is also in the statement here, and you had to comment about it. Where is it? This one here. This is a service condition. You also had to comment about it. You get?
Okay.
All right. For equity share-based payments, the standard says that the entity should consider. Can we avoid mentioning so much about the standard states or what? You can say an entity, not always bringing the standard because you've overused it. In accordance is here. So you try to make use of your English, the standard states. We are not making notes. We are not making what? We are drafting answers. We are drafting advice to finance directors. So these things of standard or what? Just say in accordance with or as per. Don't so much mention about the standard. Okay. That the entity should consider the fair value of the share or share options at grantee date. I'm going to give you how I can phrase mine. Okay. Consider the fair value of the shares or share options at grantee date. This is good. It will get you a mark. But I know with practice, you know that these are called equity instruments. Based on the above, Rumco issued 100 shares to each of its employees, and this can only vest after. This appears to be an equity share-based payment as payment for service in terms of share options, and Rumco should use the fair value at granted date. Okay. Of this is 100 times this. Okay, this is 100,000. What's 100,000 in the question? 100k. So it is this 10,000. Where do you get 100,000? Patience.
Okay, we said 100. They issued 100 options for each of the 10,000 employees. So I used 10,000 times the 10. That means 100,000 options were.
You got what is 10?
Okay. Okay, to my understanding, they say they issued 10,000 options to each of the 10,000 employees. That means each employee got 10,000 options. Oh, sorry, 100,000 options.
Are you sure?
Okay, that was my understanding. I don't know.
They gave 100 for each 10,000. So that is 1 million.
Oh, I made a mistake then. Yeah, it was supposed to be 1 million.
So you
Yeah.
missed out that free mark. You get? And this is what I was telling you. Patience used the 4%. It confused. She didn't consider the at granted date. Okay? She used the 4%. Trust me, she would get this. She would fail this mark. She would fail this mark. She would not get this. But using own figure rule, okay, she would get this. A very good mark here. So Raymond, are you seeing what I was talking about? Oh, it should be yellow. Raymond.
Yes, I'm seeing it here.
That's what I was talking about. She didn't get the other one, but own figure rule, she get the mark. Yes, this is not correct by the application. They don't, this is own figure rule. They don't punish twice. So you failed this, but you got this. Very good number of G's in your work, which is good. Joseph, as per IFRS 2, for service conditions and expenses only. So maybe patience, you forgot to talk about the service conditions. Yet they were in the statement, yet they were in the scenario. Okay? So you missed out that mark also. As per IFRS 2, for service conditions and expenses only recognized if an employee serves till the end of the vesting period. Okay, that is good because they talked about you commenting on the impact. Okay. Where the employee lived during the period, equity instruments are fortified. Of course, this G can apply for all those, so I can put it here. Which shows that you understood. Okay. As per IFRS 2, the equity instrument recognized at the grant date. My dear. Okay, this is true, but if you don't talk about the fair value of the equity oh, it's not even true. Do you know why? This is wrong. Joseph,
Yes, person.
what did you mean by the equity instruments? Probably you meant the transaction value.
True.
Okay, as per IFRS 2 expenses bonus for only employees who would exercise options through the vesting period, that is true. For their ended this, an expense of this should be recognized 15.3. Okay. Where did you miss out? 100 times 9600 2 by 2 minus this. This one. You tried to bring in
The 4%,
not even the 4%,
the 4% and
and
the 30 instead of 20.
okay, there's no mark there. Okay, Florence. As per IFRS 2, in case equity shares are issued to employees, it requires them to use share price at grant date. Okay, share price should be the fair value of this. Okay, you mentioned it. Then you get the mark because you gave it, and in the question they refer to it as the fair value. But important that you remember the concepts. You talk about the fair value at grant date. The performance condition of the scheme requires that the market price of Rumuko has to increase by from ATA, and this is the market price, therefore it has to ignore it. Okay, this is good. This is good because you're commenting about the market conditions. Solution. Don't do this again, Florence, in your answer. I told you, whatever you are drafting, you're giving advice to finance director. So if you're giving advice to finance director, they don't need your solutions. So this, don't repeat it, don't do it. Okay. So you're saying, for you're getting, which concept is this, Florence? Florence, which concept is that? 10,000 minus 100 minus 40 times 20 times this. Okay, concept is lost somewhere. I know you're trying to do something, but it is lost. But of course, you would get a mark for this on figure rule. For the double entry, you would get a mark for it. Yes, you failed here, but application you're showing that we are going to increase the equity by that much and the expense by that much. You get a mark. Michael, 100 times, okay, this is okay, 25, okay. Michael.
Yes. Yes.
Never start with conclusions in your answers. That's why I'm advising you. Okay?
Thank you.
Never start with conclusions in your answers. If you can look at all their answers, calculations is at the end. You get it?
Yeah.
So a calculation is more like you're coming to the end of your answer. So it should be always under the conclusion. In the financial statement, only the non-market conditions such as vesting conditions. Now, guys, I think the patients talked about non-market conditions. Okay? Since in the scenario, who did? Who said?
Yes, it was me.
Since in the scenario there is no non-market condition mentioned, don't bring it in your answers because it shows that you crammed. Are you getting my point?
Yeah.
So this one here, since they didn't talk about it in the scenario, don't bring it. Talk about what they brought in the scenario. Talk about how the market conditions should be treated. Okay? And then you're saying such as vesting conditions, you make it worse. You make it what?
What? First.
Yes. So, since they didn't talk about non-market conditions, don't bring it because you show that you're crammed. You're not applying. Okay. The fair value of the fruits planted. Okay, this one, nothing. Okay. So, you guys, it's amazing. Some of you have good G's and others do not have. I will share the work the way it is so you can be able to see. Now it is time I give you my answer. What I thought you guys would write, depending on what is provided. Unfortunately, none of you used the short heading technique. Did you just forget?
You are getting nothing.
Yes.
Okay.
Patience. None of you used it. We said this should be now. Okay, and how much of an expense, profit or loss? So we say it would be share based. Please mute yourself. Share based payment expense, and then you underline it. I'm going to put here a solution because if you guys are going to use this, but don't write this in your exam. It should start from here in the exam. Okay. Then we are starting in accordance